This changes everything. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a global bombshell drops as a major disruption in global trade threatens to kick off the next global recession. And we're going to make the case of why the global economy is right on the edge as it is, and anything that could tip it over would send the entire global economy spiraling down. Plus, there's a shortage of global lithium supplies projected by 2025, which is why we're excited about our sponsor for today's show, Foremost Lithium. They're an explorer, and you can find them on the NASDAQ under the symbol FMST. And early investors in explorers are usually those who are rewarded the most. We're going to show you why their chart setup could lead to a short-term trade as much as 19% and even higher from there. Check out the description or pinned comment for more information. Now let's go to Bloomberg, where we kick today's story off, because I want to take a look at the global setup here as hedge funds turn bearish on the dollar. And Goldman, they even see more losses. And ahead of the meeting, hedge funds and other large speculators switched to a net short position against the dollar for the first time since September, according to the Commodity Futures Trading Commission. Now, we talked about this on the show yesterday, and that is the value that we bring you each and every day, not only to educate you about what's going on in the world, but on our Sunday show to show you how to take advantage of that, which includes our sponsors, which we deeply vet to look for a big upside potential for you, including today's Foremost Lithium. But let's take a look now as German business expectations fall, dampening the hope of a rebound as we see the business expectations index come falling down to 84.3 from a projected 85.6. So as we look around the world, I want you to see signs that indeed the global economy is not experiencing the soft landing that these political elites promised us would happen. And as of that, because it's not happening, at any moment, just something that starts to nudge the economy over the edge could send everything spiraling down. And what's going on with global trade today, well, that could be the catalyst we've been waiting for. The economy is weak, and we've been waiting for a recovery now for some time, and it's not coming. This from the president of the IFO. This is worrying, he says. And indeed, this was all based on hope. It's like, well, the data just can't keep going down. And sure enough, it is. And this is the price you pay for flooding a debt-based economy with massive amounts of money and cheap credit, and then pulling that rug away. What happens is the economies have to come reset back, not just to where they were, but oftentimes below that, setting the stage. The central bankers around the world will be back at zero, and we're going to be mired not just in a global recession, but an all-out financial crisis. The country may witness a shallow recession in the second half as it continues to suffer from hesitant consumers, weak global demand, and geopolitical tensions. And note, it's like, oh, this is only going to be a shallow recession. And it's just because consumers, well, they're ready to spend, but they're just a little bit concerned. That's not the case at all. And while the previous expectation was for a stagnation in the fourth quarter, the latest data makes a second consecutive contraction, just as we've suggested, because the German manufacturing sector alone is actually in a depression, suggests that it's going to drag the services sector down, and without any demand from the rest of the world or the Eurozone, any hope, which is all everything's being pinned on, should be dashed. While the direct impact on growth may be limited, the issue is maybe more the fact that there's a lot of uncertainty about economic policy going forward. What we would need is a convincing economic policy strategy to get back to growth, a strategy for recovery. And the strategy is missing completely, suggesting they had no plan to begin with. And that is one of the challenges we face with these political elites and these policymakers, is they literally do not know what they're doing. The central bankers inverted the yield curves and the money curves, created constriction of credit. Everyone was excited because they thought this would lead to a slowdown in the economy to cool off inflation. And now they're finding out it's leading to something worse, and they absolutely have no plans. And I know some of you think, well, it can't be. They have to know what they're doing. And we keep showing you on this show that there's no evidence at all that they have any clue what they're doing. And as we head north, weaker UK retail data put risk of recession back on the table. Now, you may recall we talked about UK retail sales. They said that consumers were deferring or delaying their purchases. And we said that's not the case. They just don't have the money. That is the issue here. Inflation has outpaced wage growth all around the world, and not just in the US, but in the UK, in Germany, throughout Asia. And what's happening is there's not delayed purchases, it's just the inability of consumers to go out and spend like they used to when we're flooding the global economy with money. While initial estimates of UK gross domestic product in the 3 months through September showed zero growth, retail sales have since come in weaker than first thought. And that may be all it would take to shave a couple of tenths of a percentage point off growth when revised data is coming out this Friday. And optimism in business and consumer sentiment surveys contrast with a dour picture painted by mounting insolvencies. And this is exactly the point we've been making on the show. When you constrict the creation of credit in a debt-based economy, one of the first things you get is delinquencies, and you get insolvencies, and then you get defaults. And what are we starting to see more and more in these articles are those three words, providing all the evidence that we needed to validate that that is actually what's happening. What we haven't gotten to is the tipping point, but maybe that is here. As stalling retail sales in the run-up to Christmas and a warning of slowing demand from the Bank of England's network of agents. Growth is likely to remain marginal over the next year. That would not mean a soft landing, mean it wouldn't take much of a deterioration in sentiment or economic conditions. This is the point we're making the show today to tip the UK on not just them and the world into a recession. So we're at the edge now. There's just not a lot of margin for error, but let's take a look at what could happen now as we set up our story for today, because if we were to see something that would drive prices higher, particularly consumer prices, at a point where you're seeing a slowdown in the economy, well, it leads to usually one thing. And here we can see import prices, this in blue, coming into the U.S. against consumer prices in red on a year-over-year rate of change. And what I want you to see is there is a nice relationship here suggesting that if anything, any catalyst could drive import prices up, even in the short term, would likely send inflation higher. Now, this is something we obviously know and that many people are concerned about. The question then is, what would happen if you're actually seeing inflation rise at a point where total compensation growth continues to slow? Well, that leads to a recession. And here you can see, looking back at the data, now we have total compensation overlaid against the import price index, total compensation expressed by average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, that shown on a year-over-year rate of change. And look back to even to the 90s, you see that import prices shot up as a point where total compensation growth was slowing. Boom, what do you get? A recession, as you can see by that horizontal or that vertical gray bar. And notably, what happened in 1994, other than yours truly graduating high school? Well, we experienced an economic slowdown as the price index went up, at least in terms of import prices, and wage growth was slowing, led to kind of what looked like at the time, not a recession, but a slowdown. And then you see going into the dot-com bubble, we see the relationship begin. Surging import prices, wages aren't keeping up, boom, you get a recession. Happened again during the global financial crisis, and we're setting the stage up now as we head now into our lead story to make the case of perhaps why import prices are headed up, and this could be the catalyst to send the global economy into a deep recession. As shipping giants pause Red Sea route as Houthi attacks intensify, and this is a problem because in the place of global trade, if you see a constriction on supply, which is really what matters now, suddenly that means prices are going to head higher as demand looks to outpace supply. That is an issue central bankers are afraid of, and this could cause that, as AP Moller Maersk, the world's second largest owner of container ships, said in a statement on Friday that has instructed its vessels heading for the southern entrance of the Red Sea to pause their voyages. its vessel Maris Gibraltar was recently attacked. And shortly after Merrick's announcement, Germany's Hapag-Lloyd announced a halt until Monday, where they, quote, will then decide for a period after. Again, this all leads to a slowdown in global trade, threatening to send prices higher, because if you've got goods getting to the U.S., knowing it's going to be a while before other goods get there, well, this is potential to raise your prices, knowing that people have no option other than to pay. And they're fundamental to the flow of international trade. Without them operating smoothly, the domino effect of damage and disruption to supply chains caused by ships delayed and in the wrong places will be substantial. And this is exactly what we saw during, of course, the pandemic, due to constriction in supply and yet still constant demand. What happened? Prices shot up. And that is what the case here we're making, is that perhaps we see import prices go up, inflation go up at a time where total compensation growth is slowing down, and that tips everything into a recession. As disruptions in the area can snarl supply chains, as we can see in world trade. And back in 2021, the grounding of the Ever Given blocked the Suez Canal for almost a week, throwing ships off schedule for months and tightening the availability of cargo space. That accident was estimated to cut capacity by 20 to 30% for several weeks. So you can only imagine the damage this could do if it indeed continues. But something there is a big opportunity is, and that is in lithium, as a worldwide lithium shortage could come as soon as 2025, which is why we're excited by our sponsor today for both lithium. They are on the NASDAQ under the symbol FMST. Let's take a look at this company, because they're an explorer, and again, early investors, which is why we're bringing this to you, are usually those who are rewarded the most, as they're a hard rock exploration company strategically located to capitalize on the world's growing EV appetite, and is committed to being a premier supplier of North America's lithium feedstock. As the world transitions toward decarbonization, the company is focused on exploration and its growth and its 4 core projects all throughout, of course, what we see here in Quebec and in New Mexico. Now let's take a look at their chart setup, which is rather impressive. Again, you can find them on the NASDAQ under the symbol FMST. Here they're trading just as we went to film, and notably what we see is a catalyst to drive up. 19% move would be into the supply zone. You can see it came down here into the bottom zone. These 2 purple signs is a supply zone. You can see some big buyers here the other day, drove prices up quickly. This could be a fantastic short-term play. On a long-term scale, even more as we zoom out now, we're looking at the 90-day chart. You can see the volume profile line. You can see where the sellers are at. If those are broken through, then you're looking at sky's the limit on the stock if it breaks out above $4.40. So again, we're making the case here that, of course, as we bring with all of our sponsors, we take a good deep look at them to bring you the best of all opportunities, and we think Foremost Lithium is one of those. Again, under the NASDAQ, under FMST. Now let's continue, because if global trade is slowing, well, perhaps we should see other evidence of that, and we do. As Singapore exports swing into growth for the first time in 14 months, but hang on, it's because of a low base effect. Total trade increased in November, supported by growth in exports, even as imports decline. And still, the data offered little reason for cheer about the prospects of a durable recovery in trade, key to the city-state's economic performance. So here we're looking at another case that what's happening is something in global trade could cause a slowdown and tip economies into a recession. And here's the evidence of exactly what happens when you see imports coming down. We're going back to the U.S. data here of imports and goods and services into the United States against real gross domestic product. That's shown in red on a year-over-year rate of change. And guess what? Where imports go, GDP follows, suggesting that this big rebound that everyone's keyed is indeed the soft landing is more likely in the coming quarters to roll over, particularly if imports into the U.S. are indeed constrained, which could very easily happen. And it's not just from there where we're seeing problems. As China's fuel shipments stay weak, as annual quotas run dry, we're seeing demand fall all over the world here. And it's that lack of demand that, again, looks for a catalyst to kick off the next recession. Here we can see the nation exported 1.16 million tons of diesel last month, 45% lower on the year as gasoline shipments fell 40% to 890,000 tons. Both figures were higher than October, though, as Chinese refiners have been skimping on their fuel exports after Beijing told them not to expect any top-up quota allocations for the rest of the year. Of course, where energy goes, economies follow. And here we can see, looking at West Texas Intermediate in blue, now overlaid against real gross domestic product in red, both for the U.S. Of course, we know if energy prices are indeed heading down, the mythical soft landing, as we saw in last quarter's GDP data, will likely roll over and head lower. And so all we're seeing is continued signs here of a global slowdown, looking for a catalyst to send us into a recession, and what's going on with global trade could be the thing to do that. And what's happening then, if we're seeing in the bond market a response suggesting that maybe we'll see inflation go up a little more, kicking off a recession. But as yields collapse, what we're likely to see is recession. And what we're likely to see then, is inflation come crashing down. As long-dated treasuries enter a bull market as Fed pivot feeds the rally, and this is something we brought to your attention as Treasury bond ETF gains a whopping 21% from a 16-year low in October. Many of you missed out on it, but if you had our CTA Timer Pro, this looks at the machine positioning. We showed you this thing was at max short. It's so easy to use because we run a historical overlay. You wait until this thing moves off of that max short level, and that's where you buy. You could even pair it, as most of our successful traders do, with our Momentum Timer Pro report. Here you see on November 2nd, all these technical indicators switched to a positive signal. That indicated a 1 count on the daily on a buy signal, and that meant enter a trade on market open. Here it was, that green candlestick, and you'd be up 13.5%. And yes, my friends, trading can be that easy. We make it that simple. And just for the moment, I have put up 3 coupon codes for a free month because I want you to come in, sign up for these reports, make some positive trades, and then I know you'll stick with it after that when you see just how easy it is. And will the Fed continue to help out supporting lower interest rates? Well, you might be surprised. They will. As Fed's Goolsbee says, it's too early to declare victory over inflation. Well, Goolsbee, it's not. It's almost over, as we made a lot of progress in 2023, but he still cautioned everyone that it's not done, he said. And so the data is going to drive what's going to happen to rates. And Goolsbee is more optimistic than most policymakers about the prospects of a soft landing for the U.S. economy, lauding inflation progress this year, while noting it's still far off from the Fed's 2% goal. Well, actually, it's a lot closer to the Fed's 2% goal than we thought, at least they think. But what it means as we look at the rates market and see bond prices rally here, which will bring more investor dollars in, well, that means inflation days are over. Here you can see the consumer price index, this in blue, against the market yield of 10-year treasury yields in red. Of course, the CPI shown on a year-over-year rate of change. And what we know is a bond market as yields fall down, because what it means is financial conditions are tightening, inflation then falls afterwards. You can see that repeat here, kind of around 1997 going into 1998. Yields start to fall, inflation falls. You see that again going into the dot-com bubble. And again, notably, the global financial crisis, yields are coming down. You get a transitory increase in inflation, perhaps like we're going to see if global trade ends up tightening supplies and sending prices higher. And then what happens? Inflation crashing down. It repeats again around 2011 into 2013. You see rates leading inflation. Happens again in 2014, going into the pandemic ahead of time. And now we're seeing the same signs because, again, falling rates mean financial conditions are tightening. That's something the Fed doesn't get at all. And all it means is we are at a point on the edge of the cliff looking for a catalyst to send the global economy into recession. And what's happening with shipping right now could be that catalyst. But as always, with any of the sponsors we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.